In today's talk, we're going to be talking about how to build your foundation with your credit, the right formula, how to get to an 800 FICO. I'm personally divulging my trade secrets on how to rapidly get your credit optimized to the fullest extent. See, this topic with personal credit is very important for me. And unfortunately, they don't teach credit in school. You either learn from your friends or your family or going through the hard times of getting denied because it wasn't properly managed. And unfortunately, a lot of people have these challenges with their credit, and a lot of Americans don't plan their financial futures. That it's either too late. A recent study by the FTC stated that there's 1 out of every 4 people have discrepancies listed on their report. And what's the cause and effect from having these discrepancies in this bad credit? High interest rates on your personal business loans, from mortgage to car notes. I mean, just merchant cash advancements, you're paying anywhere from 20 to 50%. They'll go down to a 500 FICO, but is all money good money, right? Same thing with subprime mortgages. You're going to pay about 7 to 12%, versus if you have good credit, it could be anywhere from 2 or 3, 4, 5%, from these interest rates. Same thing with car loans, right? 10 to 20%. Credit cards, 20 to 29%, versus you getting these 0% promos with these credit cards for 12 to 18 months, or your 0% introductory rates for car notes, or 2 or 3%. Why pay more for the same material, that house or that car, if you can properly manage your credit efficiently? There's a huge emotional and financial distress that comes with this, where if you didn't have to pay 5 times the amount, what would that do with your cash flow? What would that do for your family? How would that be able to really change your outcome in your life, in your business, and your personal? So I wanted to start here with the foundation, all right, and what I call the perfect credit formula and how to get to an 800 FICO. So there's 4 different types of accounts, where we call them trade lines. You have a mortgage loan, auto loan, installment loan, credit card revolving accounts. Now, the age of these accounts makes a huge difference. The longer establishment, the higher the score goes up. Next is your credit utilization. So let's just say you had a credit card with a $10,000 limit, $3,000 balance. So you're using 30% of your usage. Once you go above 30%, it starts to affect your scores negatively. So make sure you have your balances as low as possible before that closing statement date. Next is your payment history. So no lates, collections, public records, judgments. This is going to stay on for 7 to 10 years. Next is your credit inquiries. You want to use them wisely. So the rule of thumb here is no more than 6 per 6 months. Surprisingly, it doesn't matter if you have a 750 FICO. If you have too many in a short period of time, that could be grounds for a denial with the lender. So here I wanted to talk about the tips and tricks on how to be able to maximize your credit. Some personal things that I've developed and really helped systemize my own credits from that. So first thing I want you to do is put your accounts on auto pay. You want to be systems dependent, not human dependent. So if you go on vacation for a month and you forget to make that one payment on the credit card, that 7 years, that 30-day late is going to drop your score 50 to 100 points. It's going to be on that for that period of time, that 7 years. Be systems dependent. Surprisingly, a little trick that we found is which one is better, paying off your credit card in full or leaving a small balance? We've tested that if you pay off your credit card versus you leaving a 1% balance, your score will actually increase if you have that 1%. I don't understand the formula, but we've tested it, and it's been proven time after time. Next thing is, don't close your credit cards, because what happens with going back to the perfect credit formula, you lose the age that you had that card established. You also lose a total credit utilization. So if you had a $10,000 limit on a credit card, 5 years in age, you close it, you've lost that, and the total credit gets affected, enabling you being a higher risk factor. Another one is inactive accounts. So you want to be able to pay the old credit cards every so often, every month or 2 months, go and buy some gas, pay it off within the month, some even chewing gum for all these. Just that activity is important, because if the bank knows that you're not using your account, they'll close it themselves. Usually after 6 months, it goes inactive. If it goes a little bit further on, they can close it. Now, your payment due dates and closing dates is very important. So if your payment due date's on the 1st, you want to make sure that your closing statement date is the date that the balance of that gets reported to the credit bureau. So I'm going to talk about this a little further in the next slide. But you want to be able to change it into 2 dates a month to be able to manage it correctly. So touching further on this, so be aware of your closing statement dates. As I said, if your payment is on the 1st, closing date is typically 2 or 3 days after. That balance is what gets reported. So what I've done is that I've changed my due dates for the 1st and the 15th. So when it comes down to, let's just say on the 30th, you have to pay down the cards on the 1st. You stop using it, use the cards on the 15th. Once that's closed, you go through on the 14th, you pay it down as low as possible, preferably below that 30% mark. And you use the cards on the 1st. So you swap between the two. You're leveraging your credit 30 days, not having to make one huge payment on one day. Let's just say it's the 1st. So you want to be able to leverage your cash between the two. So here's a little diagram that I drew up. So if your payment is on the 1st, you're 100%, pay down on the 30th, let it close, use the card on the 15th, swap and going back and forth. All right, you can do this with any cards. You call up the credit card company, and they'll simply change it for you. So the higher the credit score, the lower the interest. So in order for you to be approved with the lowest interest rate, of course, you want to come in with the best snapshot, right? So utilization no more than 30%. This is where you want to have, that best and highest FICO score to get that qualification, the lowest interest. Of course, there's some exceptions to the rule. Usually, like for example, with business funding, if you have other compensating factors that could explain why you have a higher credit utilization. But 50% is typically the max that I like to see when we apply and help our clients with their approvals. So, again, as I said, we optimize your personal credit. So this is what the banks want to see. Banks prefer borrowers who have demonstrated the ability to repay loans. So when your credit balance is right as limits, it sends a red flag, right, decreasing your chances for that approval. It's very funny what I say is that when you need money, it's harder for you to apply. But the minute that you don't need the money, that's when they come after you and say, hey, borrow from me. So just be proactive, with these strategies. Next thing is your credit increases. Okay, you always want to be asking for credit increases with your credit card accounts. Get into the habit, right? With credit optimization, you have to be proactive, because the more time you have with that account and that establishment, that responsibility for you making payments on time, the higher probability for the credit card companies to increase your limits. So one thing is your frequency of your spending can also increase your limits. If I have a $5,000 credit card, and every month I'm using it up for $5,000, paying it off, using it, paying it off, right? They're going to see that history in the algorithm, and that could also be a faster way of you increasing your accounts. Now, soft increase. All right, so ask your banks to increase your credit cards every 30 to 90 days. Right, of course, coming back to perfect credit formula, the snapshot when you apply, you want to have it as optimized as possible. But you don't want to do this with a hard inquiry, because that rule of thumb, no more than 6 per 6 months. You want to use them wisely. I already talked about the utilization. So what happens if you don't have enough credit, right? You need that fresh start. So there's a few different tools that we use when your primary accounts or authorized users. I'm going to get into authorized users in the next slide. But a trick that I found, there's a whole bunch of companies that you're able to apply. Like, for example, My Jewelry Club, New Coast Financial, Hutchinson Chase, Oxford Publishing. So they can give you a $5,000 limit, a $5,000 limit, $2,500, $1,500. It's over what, $14,000 worth of revolving accounts, and they accept little to poor credit with that rating. So once you start to establish your credit again, you have 14,000 versus you going straight to an account or a credit card, and they give you starting off with a $200 limit. This is a fast track for you to increase that, right? Also showing strength, because when you apply for a loan, you can't just have a $500 limit and expect to qualify for a $50,000 approval. A company that I found recently is Self-Lender. If you're definitely starting out, you give them, I think, some money and they borrow against it. Do some research. It's also a great tool to start establishing, additional credit. Another fast track is secure credit cards. And of all the ones that I've found, a lot of them want to charge you a 19, 20% interest rate. The ones that I found was the lowest is Primor card, I think by Berkshire Bank. It's a 9.99%. Some gold card, I believe, with from what I found. But if you get 2 or 3 of these secure cards, 2 or 3 of these My Jewelry, New Coast, within 3 to 4 or 5 months, you're going to have a well-established credit. Of course, the rule of thumb is 2 years, but that can also really expedite and give you that strength. Now, another easy qualification is installment loans, right? Like the mortgage or auto loans, because it's collateralized, right? You're buying a house. What happens if you don't pay? They take the house away. If you don't pay for your car, they repo it. For those of you who have some liquidity into your bank and you have cash, you can borrow against it. Go to your credit union, go to your bank and say, here's $20,000 or $10,000. I want to borrow against my money. You open up 2 or 3 of these accounts. You rinse and repeat every 6 to 12 months, pay it off, rinse and repeat. You're establishing a stronger profile, higher limits. You can do that with revolving as well. Great tool. Now, Authorized Users is a great, another great tool that we use all the time. So if you have any friends or family that have the perfect credit formula, right? You don't want to have somebody with maxed out credit cards and you add yourself. But what happens here is that if you have a credit card with a $10,000 limit, 5-year in age, you add yourself to that credit card. All that history is going to merge and duplicate onto your credit. Every account that we add can increase your scores from 5 to 20 points, sometimes even more once it's mirrored. It also does have an effect of offsetting your total credit utilization. If you're 100% maxed out and you add a high limit, longer of age credit card, it can reduce that from 100% maybe down to 75, right? They still look at your individual utilization, but everything does help. Now here's what I call the shift to debt theory. So for those who have maxed out revolving accounts, and revolving accounts has a different classification versus installments, right? Because if you have a $10,000 credit card, you go to Vegas for a day, you put that, take out the money on the credit card and max it out, you lose, that fluctuation really dictates your credit score. So by optimizing it and having it done, but if you can't and you're able to qualify for an installment loan, if you shift it from revolving to installment, that will actually increase your score because of that classification. Okay, we just talked about the revolving. So, and of course, coming back, if that snapshot that you take, if you're able to pay it down with revolving, it's always best. The higher probability when you apply, or even by adding a few authorized users. So that can all have an effect on the qualification with the lender that you apply for. So the difference between that, right? And even so, another theory that I've developed is that, let's just say you have a credit card with a $10,000 limit. I'm actually going to explain that into the next slide. So if your current situation is this, right, you have 5 accounts at $10,000 in limits. One of them's maxed out, one of them's at 50% utilization, one's at 20% utilization. So if you balance transfer these accounts, right, not spending any money, just simply shifting the debt from one to another, so you can see I evened everything out. Now you're at a 34% utilization. Your scores are going to increase just from this theory. So just be aware, that sometimes there could be a 2% fee for balance transfer. Some of them do it, some of them don't. But if you're able to even out the ratios, it has a huge, huge effect. Now, what is the recap here? So the combinations of authorized users, balancing out your ratios, and shifting the debt from revolving to installment, naturally your scores are going to increase, to that limit that you're looking for. And how much is it going to cost you? Zero. Right? These are all free strategies that is up to your disposal on fixing what needs to happen. So you always want to be able to maintain your credit. You have no excuses. Education is there. Because if you want to live a stress-free life, you have to know how to play this game. It's very essential. So sometimes when people are in let's just say in trouble, right? What's the first thing they do when you lost your job and you don't have enough income anymore, but you have a high credit limit, you have a high credit card with a large limit? The first thing you do is use your credit cards and max it out. So your creditors, your American Expresses, your Bank of Americas, every month they monitor your credit. They want to see is there any challenges that's going to happen with this person, right? And the first thing they want to do is they're going to slash your limits as much as possible, so it limits their risk from your distress. Because what happens if you don't pay your credit cards? It's unsecured. The only thing they can do is do a charge-off, sell it to a collector, but there's no recourse for them. So they're very stringent and they monitor on a daily basis. One of the biggest things that I also come across is, protecting your identity from fraud, right? The whole Equifax breach that had happened. What can you do to prevent something like that? So of course you can go to, freeze your credit from the credit bureaus. If you have an Experian.com account, you can just press a button and freeze it. You also can put a fraud alert, right? So for us, when we apply for loans, we have to make sure that we remove the fraud alert before we apply. You could actually get denied if you have that fraud alert on your credit. So of course, for when you are ready to apply for something, remove it. Once you have qualified and you have that new account, you can go ahead and put it back on. But I've listed the numbers here that you can call to remove that if needed. Now here I wanted to give you guys a little bit of a bonus, a strategy called credit card churning, where you never have to pay interest for your credit card again. Of course, to qualify for this, you need to have excellent credit. But if you want to take advantage of these 0%, 6 to 21 months, right, where I call free money, or even take advantage of these reward points for free flights and rentals and toys and any merchandise that they provide you for you spending money with that particular credit card issuer, this is something it's a really, really great tool. Now, so what happens is that at the end of the promo, right, 12 months, you have 0% introductory rate. You can do is qualify for a different credit card and leave that one aside. Sometimes what I've done with Discover, for an example, I had my 0% introductory rate for that 12, 18 months, whatever it was, and all of a sudden the next payment, the next billing cycle, I see there's like a 22% interest rate. I'm like, call them up. I'm like, hey, what's going on with this 22%? I would like to stay with you guys, but I'm not going to be paying this high interest. So let me go ahead and renew that promo and 0% for another 12 months. So that is possible. Of course, they take a snapshot of soft inquiry. They're going to take a look at your credit, and sometimes they'll honor that. But if you take it from one credit card to a next, you can keep on flipping and take advantage of that free money portion. Now, with business credit cards, it doesn't show up on your personal, so it's hidden under the company, not from you personally. So there's a really great additional benefits from that. Well, what I wanted to leave you guys off with is, education is key, right? Personal credit is the foundation for building a strong future. As I said in one of the first slides, if you were able to qualify for a 3% rate for a car versus a 20% car, I mean, that's a $500 to $700 difference for that same value, that same vehicle from it. So with credit, we have to be proactive, not reactive. Okay, have one of these free credit monitoring services. Make sure that it's in line. There's a ton of tools and education on the mechanics of all credit, but be proactive. Utilize these tools that I just described and implement it into your life, and implement on how to get that and maintain that high credit score. All right, so these are great tools. I want you guys to understand and to maximize them. Again, guys, thank you so much for attending. For us, if there's any questions you have on personal credit or business or personal loans, this is what we specialize in. We're very educated in these fields, and we're happy to have a consultation. If you have any questions, go through scenarios. Website is delivercapital.com. If you're a partner and you have a book of business, or you have clients or referrals that you want to send, by all means, sign up as a partner with us, and let's put a compensation element where you get paid for any referrals that you send. So partners at Deliver Capital is our email if you need it. If you have general questions, or you're interested in learning more, applying, or getting education yourself, you can email us at info@delivercapital. Of course, call us at 888-311-9894. Got a little mixed up there. Is 888-311-9894. Thank you, guys. Have a wonderful day.